Welcome to the deep dive.
Hey, glad to be here.
So we are looking at the financial survival playbook for independent medical practices in 2026.
Right. And the stakes are just massive right now. I mean, medical staffing is growing incredibly fast.
Oh yeah, it really is.
But the cash flow is totally brutal.
Right. Owners win these huge medical contracts, but then they actually turn them down.
Yeah, because Payroll Friday hits way before the hospital actually pays them.
Exactly. And most owners hear the phrase line of credit and they just think of a bank.
But the bank is totally the wrong door here.
It really is.
The right product actually exists, though. And it is the difference between a 5-nurse agency and a 50-nurse agency.
So before we really go deep into the sources, run the true cost of waiting calculator at BusinessLoan.Directory.
Yeah, you plug in the contracts you turned down last quarter, the number is going to sting.
It really will. So do that and then come back.
So hospitals pay on net 30 to net 90 terms. That wait completely breaks the whole system.
Because your nurses get paid on Friday.
Right.
And commercial rent is always due on the 1st.
Right. Let us say you have $60,000 in weekly billing.
Okay.
That means $30,000 in payroll goes out before invoice 1 even clears.
Wow. So you need almost $200,000 in working capital just to bridge one single cycle.
Exactly. And banks look at that and just see incredibly thin margins.
Yeah. They see no hard collateral and lumpy receivables.
Yes.
So they just pass.
And that leads to the capital trap. Owners get desperate and they try credit cards first.
Right. Then they turn to merchant cash advances, or MCAs.
Yeah, the MCA daily withdrawals just strip cash way faster than the payroll cycle can replace it.
12 months in and the agency just closes down entirely. It is a totally vicious cycle.
But there is a better way. It is called an accounts receivable line of credit.
Some people call it payroll funding or invoice financing, right?
Right. You invoice the hospital today,
Yeah.
and the lender advances 80 to 90% within 24 hours.
So you actually make your payroll on Friday, and then the hospital pays in 45 days.
Exactly. The remaining 10 to 20% releases to you, minus a very small fee.
And the underwriting completely flips here. The lender scores the hospital credit and not yours.
Because the hospital always pays eventually. So a 700 FICO owner and a 600 FICO owner get the exact same line.
As long as the billing matches up. And it is not a loan, so there is no debt on the balance sheet.
Right. It does not kill your debt service coverage ratio for a future SBA move.
Which is really crucial, because the SBA made a huge rule change for 2025.
Oh, yeah. They officially banned using 7A loans to refinance those toxic merchant cash advances.
The government finally recognized the trap. They are firmly closing the escape route for bad debt.
They also completely changed the rules for microloans in April 2026.
Right, you need 100% U.S. citizenship for all owners now. Legal residents are totally locked out.
So getting the right capital early is vital. You need a clean aging report to get a bigger line.
Because it tells the lender which hospitals pay on time and which ones drag their feet.
Exactly. If you have a clean aging report, you get the absolute best advance rates.
And you can pre-qualify at BusinessLoan.Directory. It takes like 2 minutes.
They ask the specific industry questions that these lenders actually need.
Right. BusinessLoan.Directory 75+ lender marketplace routes, medical staffing, straight to accounts receivable specialists.
Not generic banks. And definitely not MCA brokers.
Because the factoring illusion is dangerous. Factoring companies offer a 2% fee, which sounds incredibly cheap.
It sounds cheap, but on 30-day terms, that is actually a 24% effective APR.
Wait, that is literal credit card debt. But an accounts receivable line on the same billing only costs 1 to 2% total.
Right. An MCA is literally 10 times more expensive.
So independent practices face this exact same cash flow gap, and the human toll is massive.
It leads to the dreaded pajama time.
Right. Doctors sit on their couches doing electronic health records late at night.
A typical 30-minute visit creates over 6 minutes of extra administrative work.
Emergency medicine burnout is near 50% right now. It is just incredibly heavy.
Almost 21% of physicians spend over 8 hours weekly on pure busy work.
Wait, let me challenge this idea right here, though. Are doctors quitting medicine, or are they just quitting the business of medicine?
Well, they are fleeing the administrative tax. They sell out to private equity just to escape the endless paperwork.
But they trade pajama time for volume quotas. Corporate platforms force them to see more patients in less time.
They lose their clinical autonomy completely. They just become a cog in a massive billing machine.
The administrative tax is just everywhere. Look at the dental sector for a prime example.
Oh, wow, yeah. Front office staff spend up to 40% of their time strictly on insurance paperwork.
You literally have to hire a dedicated insurance coordinator just to fight for the money you already earned.
And that coordinator makes around $60,000 to $80,000 a year. That is a massive chunk of overhead.
If insurers just paid faster, we would not need this crazy debt cycle.
What there is CMS Rule 0057F trying to fix exactly that.
Right, by 2026, payers must make prior authorization decisions within 72 hours for urgent care.
And they have to use new application programming interfaces by 2027, so computer systems can finally talk automatically.
But insurers fight these rules constantly. Look at the massive Delaware penalty for United Healthcare.
Oh, yeah. They fine them $450,000 for Mental Health Parity Act violations.
Because they ignored standard clinical criteria for addiction treatment, right?
Exactly. They just use their own highly restrictive internal guidelines instead.
Wait, though. If states are actually finding insurers, why are independent doctors still struggling so much?
Well, $450,000 is pocket change to them, and there is a 2025 enforcement pause on parity rules.
Oh, I see. So providers still have to fight for every single dollar entirely on their own.
Yep. And the 2026 Medicare physician fee schedule just squeezes them even more.
Yeah, you get a small 3.7% boost for alternative payment models.
But there is a negative efficiency adjustment attached to it. They literally cut baseline pay for standard services.
And telehealth revenue is just as chaotic. State laws vary wildly in 2026.
Some states guarantee you get paid the exact same rate for virtual care. Others offer zero protections whatsoever.
Plus, the Stark Law makes value-based care terrifying. It is a strict liability statute.
So your actual intent does not matter at all. One billing mistake, and it is federal fraud.
Like accidentally sending a patient to a lab your brother owns.
Exactly. Well, new exceptions do protect doctors who take on downside financial risk now.
Right, meaning you risk repaying at least 10% of your earnings if you fail to achieve good outcomes.
So practices absolutely have to control their own operations. Let us talk about AI agents.
This is huge for dermatology. They suffer 20% denial rates normally.
Which is triple the industry average. They lose tens of thousands of dollars purely to bad billing.
So how do browser-native AI agents actually fix this?
They literally log into the insurance portal just like a human digital employee would.
They type the password and navigate the multi-factor authentication texts and everything?
Exactly. And they check the exact status of every single claim every single day.
Oh, wow. And they drop days sales outstanding from 90 days to under 24 hours.
Picture a Monday morning 2 months from now. You have 50 nurses across 3 hospital systems.
You have 200,000 available against 400,000 in receivables.
You are quoting a 40-bed allied health contract, and you commit without doing any payroll math in your head.
The owner who turned down the contract last year is still turning them down. But you won.
Getting cash that fast is just a total superpower.
But holistic doctors manage this entirely differently. Functional medicine uses very different tactics.
Right. Standard coding fails them, so they use strict time-based coding because their visits are much longer.
They also mix in cash pay models. Patients use their FSA limits of $3,400 for advanced care.
But scaling up brings massive compliance hurdles. You really have to watch your business associate agreements.
Right. You must make your vendors slow down high pay rules to their subcontractors.
If you do not do that, the government holds you completely liable for their data mistakes.
Fixing your revenue cycle makes your practice a prime target for private equity, though.
Because there is a massive valuation gap right now. Independent practices sell for 4 to 9 times earnings.
But integrated private equity platforms sell for 12 to 15 times earnings.
So you really must act like a platform yourself to survive this. Consolidate your technology stack.
Secure lines of credit before you actually need them. And take advantage of Section 179 tax deductions.
Right. You can deduct up to $2.56 million for qualifying new equipment in 2026.
You can write off the entire purchase immediately instead of depreciating it. It is an amazing strategy.
So the tools to survive are definitely out there for the independent practice.
But I want to leave you with a final provocative thought here. AI is slowly eliminating the administrative tax.
Will this spark a new renaissance of the independent local doctor?
Or will massive corporate healthcare use that exact same AI to make their monopolies totally unbreakable?
That is the ultimate question for the future of medicine.
If your true cost of waiting number was bigger than the cost of an accounts receivable line, The math told you to move months ago.
Go pre-qualify at BusinessLoan.Directory. 2 minutes, no hard pull. Then go win the contracts you have been turning down.
Right, capital at the
Yeah.
right time.